Hi, everybody. Thank you for joining the session. Today we'll be talking about investment banking, what that career trajectory sort of looks like, and how you can get into investment banking. Today we will have Chandra and Chris from Goldman Sachs presenting and telling us more about what that entails. Feel free to ask any questions in the chat box, and I think similar to all the other sessions, you can, add all your questions and we'll collate them and ask them toward the end. I would request that you direct it to a specific person so that we can be very targeted about our questions.
Thanks, Terry. And then students, so sad we can't see your face and engage with you as we would in the live setting. But I will say I don't know the background, how much familiarity you have with investment banking. So we'll try to keep this pretty high level for those who may not have a ton of background. So be sure to ask, any granular questions you may have in the chat, and we'll address those at the end. So we'll go ahead and start off with some panelist introductions. I can go ahead and introduce myself. So I'm Chandra Sahu. I attended the University of Michigan, and I'm also from Michigan. My pronouns are she, her, hers. I attended the O4U Business Conference for the first time as a sophomore in 2016, where I met a Goldman Sachs recruiter who would end up being pretty critical in my trajectory. And so interned at Goldman as a sophomore in the real estate classic group, and then junior summer switched to the consumer retail group and returned full-time in that group, where I've been for about a year.
I'm Chris Elmore. I'm a vice president at Goldman Sachs. Did my undergrad at Stanford. I actually almost predate O4U. So I did my first internship at Goldman in the summer of 2007 and came back full-time in 2008. I sit within our public sector and infrastructure banking financing business and co-head our transportation and P3 group. So I do financing for toll roads, airports, ports, and the like.
Hey everyone, my name is Michael Parrish. I'm a vice president at Wells Fargo and their middle market investment banking team. My pronouns are he, him, his. I graduated from UNC Chapel Hill in 2012. Have been with Wells since then. I did the analyst associate, and now I'm in kind of my second year as a VP. I'm based in Charlotte, and my group is kind of a specialty group. We do all products and all industries.
Hey everyone, my name is Madalena. I am Portuguese. I started my career in London. I've been with Morgan Stanley also in São Paulo in Brazil for a couple of years. I now sit in New York. I'm a second year VP. I cover natural resources, ranging everything from petrochemicals to specialty chemicals, packaging, you name it. And really happy to be talking with you guys.
Hey guys, this is Ferris Amache. My pronouns are he, him, his. I'm a third-year associate at Macquarie Capital. Graduated from the Ivy School of Business at Western University in 2013 in Canada, and had a bit of an unusual career path where I started on the buy side, moved over to the banking world last year. I focus on infrastructure and energy M&A.
Hey everyone, my name is John Jambroni. I go by he, him, his. I use he, him, his pronouns. I'm a second year associate at RBC Capital Markets here in New York. I do equity capital markets and focus on the kind of specialty product part of it, which is equity linked and derivative based financing solutions.
Thanks, everyone. So we'll start off with just a general overview of investment banking. So as an investment banker, we provide corporate finance and advisory services for clients. One of the ways you may hear banking described is that you match people who need capital money with people who have it. So whether that's through M&A transactions when companies want to buy and sell each other, accessing public markets with IPO, or just thinking generally about capital structure and capital allocation, that's where we sit as investment bankers and the advice we provide clients. And then generally in banking, you'll see that it's divided into product groups and industry groups. So Product groups specialize in one or a couple of financial products across industries. So that could be M&A, equity capital markets, debt capital markets. So you're really drilling down on a specific expertise and applying it to a wide variety of clients. Whereas in industry groups, you specialize in one industry, but you cover a number of financial products. So, you could cover a client and help them through their M&A, IPO, et cetera. Some example groups would be technology, media, and telecom, which you may hear referred to as TMT, financial institutions, natural resources, consumer retail. And one note I'll make here is that every bank is maybe organized a little bit differently. So for example, at Goldman, our M&A expertise is embedded in the industry groups. So our industry groups touch M&A and a lot of these other product groups, but we bring in our product groups to support the client and present one firm. So in your networking, would be careful to make sure you're doing a lot of research and understanding the way that the bank you're talking to organizes their groups, and make sure you understand kind of what your role would look like as a summer analyst or full-time analyst in that group. So as Terry mentioned, we're going to provide an overview of what the interview for investment banking looks like. And generally that will cover 4 topics. So why banking? Why are you here? Why this specific bank? Some methods of valuation. So deal and trading comps, discounted cash flow. And then finally, industry landscape. Are you abreast of trends in the industry? And are you really invested in understanding what's going on? And all of that hopefully will result in an offer. So that is the end goal here. So here's just an overview. So for why banking, a lot of the interview questions, while you will see technical questions, are actually fit questions. People want to make sure that you understand the role and understand how you can be a best fit for it. And so you want to craft a coherent story, but be really genuine and make it clear how you're getting from A to C. Then we'll go into a couple different methods of valuation, some that are relative to other peer companies and some that are intrinsic. So, one, looking at the value of company based on the cash flows that it itself can generate rather than comparing to peers. And then we'll go over some industry landscape questions that you may see in your interview. So taking a step back, for interview process and timeline for banking, it can be a bit accelerated when compared to other industries. So generally, you'll recruit in the late spring or early summer. So maybe you're starting to reach out to folks mid-spring, starting to have a lot of conversations with different product groups to figure out really where you may be a best fit, though of course you'd likely be open to many. And then you'll have a first round interview, likely virtual in this environment, but it could be either in person or virtual in a regular environment. And this will be largely behavioral. And then your second round in banking is super days. And so this will be usually one day of interviews where you have, maybe 3 to 4 interviews. You could have 1 to 2 interviewers in the room with you or, in the Zoom room. And this will focus on a lot of fit and also really digging into the technical expertise and seeing, how you'd be a good fit for a particular group or for the investment banking division at a firm. So as we've covered, there are fit questions, technical questions, on accounting and valuation, and then industry questions. So testing your knowledge in the industry and what you're really interested in there. And finally, the very important piece is one question you definitely will get, which is walk me through your resume. And so you want to develop this as a coherent story that's not literally going line by line of your resume, but instead shows why you're sitting in that seat today talking to this specific bank and this specific role. So, maybe it started with an interest driven by certain clubs and evolved. And you want to make sure that you have ties that show that you are aware of what the role requires and what makes a successful analyst and what skills you have to bring to the table that would make you that successful analyst. So crafting the story. You can bring into your story prior internship experiences, classes, clubs and extracurriculars, and personal interests. And so these are things you can begin to craft, especially if you're a freshman or a sophomore, as part of your experience on campus to inform your journey and your story. Some of the key traits that we will be looking for in an interview for a summer analyst or a full-time analyst are responsibility, teamwork, technical analysis, whether that's in finance or applicable in another experience you have, and client service. So those are all things that you'll want to be able to look at your experiences and say, okay, how can I exemplify all of these traits? Chris, I'm wondering if you want to overlay perhaps some great examples of stories you've heard in interviews and versus maybe a standard example that doesn't tell you as much about the candidate.
Yeah, certainly. So I think what I tend to look for when conducting interviews around the underlying story are two pieces. One is focusing on, this goes back, I always think about it as like going back to your high school English teacher who would always say, show, don't tell, show, don't tell. And so finding a way to show your interest in investment banking and how your prior experiences tell a narrative that brings you to why you're interviewing for banking. And secondarily, looking for intellectual curiosity and understanding not just, oh, I'm interested in banking or I'm interested in this group in banking, but how do you tie that back into showing me the interest? And so the examples that I typically see are most compelling are when you can walk through a resume and say, here's what I liked in my prior internship, here's what I didn't, here's how investment banking fits better. Here's a story I read in New York Times Deal Book that really interested me. And so here are all the things I did afterwards to learn more. And in that process, realize that I tend to read articles about technology company IPOs. And so that's why I want to interview in equity capital markets, or I want to work in tech media telecom. Or you might say, hey, I read all these articles on airlines and I realized I'm super interested in that industry. And I heard about this financing transaction and did more, pulled up the public filings. That both shows a true interest, it tells a cohesive story, and it shows that intellectual curiosity about some of the very fun things we get to do in this business. And that's always much more effective versus saying, hey, I'm interested in this industry. Show me that that's the case.
Thank you. Very helpful. And I just want to overlay, the reason we spend this much time on this question is that client service and the way you present in front of clients is extremely important in this role. And you're always crafting a story, and you have the deck behind you to act as your support, but you're crafting a story for the client. And so in this initial first impression, you want to make it extremely clear that you know what the role requires and you have all of the experience to make you an excellent candidate in that role. So we'll turn to our panelists now, and wondering if you can share how you answered why banking then, and maybe how you would answer it now.
Yeah, I'm happy to start. I don't know that I had a great answer back in the day, which might not be a good answer here. I came from a background, I was a first generation college student, didn't really know what investment banking was, so I kind of had to learn along the way. And so I knew kind of the elements of investment banking that were attractive to me, being a type A personality, and kind of knowing what I didn't like about some of the other majors that I had thought about when I was an undergrad. So short story, I'm not sure that I had a great answer. But today, kind of like Chris and Chandra were saying, like, I think you can show through your experience, your interest in IB. A lot of people join clubs. They take on initiatives outside of kind of their formal extracurricular activities, whether that's, starting a fund for investing, which isn't exactly what we do, but there are a lot of different things you can do. Sorry, I was a bad answer. Hopefully everyone else has better answers.
Yeah, happy to go next. So for me, I think the way I approached it when I was interviewing was, first of all, I really want to understand what does an investment banker do, and we covered that a bit in the beginning of the session. But the creativity, I think, that comes with understanding what makes a company tick in terms of like how do they make money, where is there potential need for someone else to come in and help them be better, whether it's through funding, expansion or an acquisition of another company, and being able to kind of just dig deep and really understand how a company works, understand how it can be better, and understand who out there can make them, be better. Essentially is what really attracted me to it is the creativity and being able to kind of put different pieces of the puzzle together and kind of make something out of create more value out of something that's perhaps not as I guess as positive without the two coming together. So that I guess would have been my response.
I would say if we can describe banking and especially the analyst level, it's a very competitive environment, it's fast moving, is a challenge, an intellectual challenge, and also a skill development challenge. So we know day one, it's really different from 3 months down the road. So you guys develop a lot of skills. So liking this lifestyle, liking to be exposed to really competitive colleagues and situations, loving to do 3 things at a time, loving to be exposed to challenge, all types of challenge. I think this is what we want for good analysts, right? So when I recruit, and I was a staffer for many years in my group, I think having analysts or people who want to be analysts showing that they tick all these boxes and give examples like, I play tennis for many years at a competitive level. I hate, doing the same thing over and over again. I always look to the next challenge. I hate being quiet. Again, there's nothing wrong about who likes to be quiet and who likes more repetitive tasks. There is no good or bad answer here. But what I see is analysts succeed when they fit this lifestyle, and where they don't fit, they don't become good analysts, or they have difficulty in progressing in the recruiting process. So I try to give a lot of examples of my lifestyle that prove that I would be successful in this job.
Thanks. And I'll just echo, I did a lot of that similarly in my interview. I was not super involved in investing clubs. A lot of my interest was in recruiting events that I did on my own, research that I did on my own. And so my interview really focused on my self-assuredness and being able to do the job and the skills it requires. So I knew it was intellectual curiosity, willingness to really grind on multiple responsibilities, and teamwork. And so those were the 3 things I focused in on, and I was really highly involved in college. And so that was part of my answer. And I remember my interviewer, because one of my spokes was being like, I know that I can handle the competing demands and workload, he asked me to walk him through a typical week in my schedule, and I did. And he was like, yeah, it sounds like you're pretty prepared for this. So I think any way that you can show that you understand the needs of the job, whether it's in the technical aspect or if you don't have that background from the lifestyle aspect, will really benefit you.
And if I can add just one point here, I tend to see that this fit and exactly what Chandra just described, giving these examples, it's really, really important. I think there is a mindset in banking that the technicals and the valuation you can learn, right? But having this, and that's where you should focus a lot, is showing that you have these skills required for the job. And the technicals, like, you can relax, because people know, even if you show in the interviews that you know a lot, everyone expects that you will learn on the job, and you cannot learn skills. It's more difficult at that point.
Definitely. So speaking of technicals, we'll move into a brief overview of the few valuation methods that you will need to be familiar with if you're moving into an investment banking interview. So the first part we'll focus on is relative valuation with deal and trading comps. And so the relative just means that you're looking at valuing a company, based on its peers. And an example that I've heard for this is, if you're trying to value your house on a market, you are going to compare it to the other houses that are around it and see, like, okay, are there specific aspects that make this house nicer, but this neighborhood overall is going to have some value ascribed to it. And so generally, when we're talking about value, we're talking about enterprise value, and there are a number of ways to get to this. But a simplified way of looking at it is thinking about if you were someone who wants to buy the company. So you'll have the equity value, all of the shares of the company multiplied by that share price, plus the debt, because that's now an obligation that you'll have to the debt holders, minus cash, which you may use to pay down that debt after you've bought the company. And so that gets you, in a very simplified version, to your enterprise value, which is the total value of the company you'd be looking at buying. There are a couple of important metrics we look at when we're looking at company valuation. So one is EBITDA, that's earnings before interest, taxes, depreciation, and amortization. And if you haven't taken accounting, some of that may sound very foreign, but the point is that this is a way to look at earnings across companies and cut out the noise of their capital structure. So you're cutting out the noise of, interest rates and their specific tax rate, and the depreciation and amortization of their physical and intangible assets to get to an earnings metric that is more comparable across capital structure. When you look at looking at multiples to value companies on, EBITDA is one that we use often. So you're looking at what is the value of this company if I were to buy it, as a multiple of its earnings when you strip out all the noise of capital structure. So we would use that multiple then, once you get that for one company, you'd compare it to the multiples of other companies to see how they stack up in terms of the value, how many times over their earnings they're being valued. Another multiple that we use similarly to compare companies is price to earnings, PE. You'll hear that often. And so one way we've shown it here is price per share over earnings per share. The same equation could be written as market cap over net income, because your market cap is the number of shares outstanding times the price per share. And then your net income is, earnings per share times the number of shares outstanding. So you may hear it phrased either way, but this is looking at, in the current public market, how do investors value you over the earnings that you're currently, creating? So your PE will be higher if people assume that there is going to be, more future growth for the company. And so when we're looking at both PE and EBITDA, you want to pick the companies that you think are most applicable to your focus company when you're comparing them. And so comps may be selected in similar industries, geographies, by product that you're offering, margins, so, what's their cost of goods sold versus, their sales, and then size and business model. So really you just want to make sure that if you're comparing this house to the houses on the block, that the houses are all generally similar. The little bit of color we want to add here is that sometimes comps will be different than what you would necessarily expect. So for example, I had a summer analyst on my team this year who for his summer project had the company Hormel. And if you're familiar with it, they're broadly known for packaged meats, but in the past few years, Hormel has been moving toward more packaged goods, more snacky foods, like peanut butters and things like that. And so while you may have thought, okay, it's a meat company, let me grab all of these other like Tyson and a bunch of meat companies, a lot of them are private, so it doesn't really help. You would instead say, okay, what are some of the packaged good companies that may be comparable now, like Kraft Heinz? So that's one example. And then Chris, I'm wondering if you can help us think about another way we think through comps in a more, creative, analytical way.
Yeah, certainly. Thanks, Chandra. And I'll use some examples from the infrastructure space where I live. And it's rare to have two infrastructure people on one call. So I'm actually, Ferris will get mad at me if I go off piste here. But, one of the other things that we'll often see is that we're trying to tell a story for our client as well. And thinking about what the comps are, not only for the really simple, I'll say a toll road, it's like, okay, I can pull all the toll roads in the US and stack them up to, next to each other and tell a simple story, but also what the client is trying to tell the market and what story you are trying to help tell to the market, whether you are working with them as a sell-side advisor or for an IPO or for a debt raise. What's the story you're trying to communicate? So an interesting example I can think of was we were, looking at some airport comps, which tend to have a lower multiple than toll roads. But we were also looking at an airport that's very, very stable. And so if you step back, you can say airports, toll roads, at the end of the day, they're all about travel. And it's all around mobility. And so if you have a really stable airport, can you start telling a story that it should be valued more like a toll road versus an airport? And to help the client frame themselves as having an aspirational value which may be higher than the other direct airport comps. And so as you start thinking through what your comp set is, it's not only what is the easy, what's the easy, basic, and simplest thing you can pull, but also what story are they trying to tell? And I think this goes back to the example that Chandra was telling also, is that if you look and you talk to Hormel, I would guess that they would say, yes, we used to be a meat company, but that's not what we are today. And so part of the job in banking is not only doing the, hey, I read a document and I have a guess of what industry you're in, but also really understanding how that business may be evolving over time and what comps provide good insight for your client, for investors, and can tell not only the story of their history, but also telling the story of their future.
Thank you. Okay, so I do want to leave a good amount of time for questions, so I'll just start this off by saying DCF is something that you'll want to get familiar with on your own time as well. I know that there are lots of guides out there, lots of YouTube videos that you're probably familiarizing yourself with. So this will be a pretty high-level overview, just so we have time for questions, but please feel free to reach out to myself or any of the panelists with more, more specific questions while you're doing your own research. So discounted cash flow analysis is an intrinsic valuation. So you're trying to value the company and what you would pay for it based on the free cash flows that you think it's going to be able to generate in the future. So starting off, we're using free cash flows because similar to EBITDA, they strip out the noise of financing and other things down the capital structure. And so that is why you're projecting out these free cash flows rather than, say, sales. The reason you're discounting these cash flows is because there's a concept called time value of money. And so $1 today is worth more than $1 tomorrow due to a number of factors, inflation being one of them. And, for example, if you invested $1 today, you could grow it at a rate instead of sitting on it and letting it depreciate in value. So that is why we're choosing to discount the cash flows that we project back to the present value to understand what their real value is today if we were to buy the company today. So step one of discounted cash flow analysis is to project your cash flows. So you're going to do this for a set of years that you choose. It could be 3, it could be 5, it could be 10 is, what you might hear, but that's really on the longer end. And you usually want to keep it shorter. So we're showing 3 years here. And the reason for that is that you want to be as accurate as possible in these cash flows that you're predicting by year. And, the assumptions that you make around free cash flow in year 6 is going to be a lot less informed than the assumptions that you're making around year 1, potentially. So that's why you try to shorten kind of the years that you have in the beginning. So you'll project out those cash flows and discount those cash flows to today's value. And to discount those, we typically use the weighted average cost of capital. So that is looking at your cost of capital, both for debt and for equity. And then you're next going to determine a terminal value. So at the end of the day, with the discounted cash flow analysis, you're saying, what are all of the cash flows that this company is going to generate forever? And let me figure out the value of those cash flows today. So you're going to project out these specific years with as much granularity as you can, with as much information as you have around assumptions. But then you have, from year forward to the end of time. And so that's called your terminal value. And you want to figure out how to value all the cash flows that are going to go out for that period of time. There are generally 2 methods that you can use to do this. The first is the perpetuity growth method. And so this assumes that you'll be growing at some rate, a low rate, for forever. So that might be GDP or inflation, but you take your cash flows in that year end, year 4, or whatever it is, and assume a growth rate forever. Now, the thing about perpetuity growth is to assume growth forever is a bold assumption to make, and also, many companies that we see today have been around for 100, 200 years max. So just put that in as a caveat, something to think about with the perpetuity growth method. It likely won't show up in interviews, but as you're thinking through conceptually what it is that you're doing, that's just something to consider. The other way to derive a terminal value would be with the multiple method. So this would be looking at your EBITDA in year N and looking at a terminal value EBITDA multiple that perhaps is derived from research to come to a terminal value of free cash flows in the terminal per perpetuity period. So then you would discount those values by the weighted average cost of capital, sum up your year 1, 2, 3 in terminal value, and that gets you to today's value of all of those future projected cash flows, which is what you would consider your enterprise value, what you're willing to pay for the company, the cash that it's going to be generating. I'll pause there. Chris, anything you want to overlay? I know it's kind of like a lot to digest at once, but.
Yeah, I think the two things I would note around DCF, particularly in the interview context, one, the great thing about a DCF is it's intrinsic to the company. So this is going to be very specific to exactly what you're looking at versus all of the other methods we've talked about or trying to compare them to other parts of the market versus saying, well, let's just look at you and exclusively this particular business. So people tend to put a lot more weight around a DCF for valuation purposes and tend to use any of the public comps or trading comps more as a way to confirm what the DCF said, more so than as the intrinsic valuation itself. The second thing I would note about a DCF is I think the really core concepts here are understanding and how to project in the near and intermediate term what annual cash flows will be. And secondarily, that, as Chandra was saying, $1 today is worth more than $1 tomorrow. And as long as you have those core parts of the concept down, that's going to be really the most important piece. Going back to some of what Madalena was talking about, we will teach you the mechanics and how to do the nitty-gritty math in Excel to make the DCF work. The important piece is having the understanding of the theory behind it, why we use it, and what it's valuable for. And all of the nitty-gritty mechanics will help you pick up once you join the firm that you get an offer from.
Yeah, I would just overlay on that as you are prepping and going through these guides and trying to memorize these formulas. Really try to understand the theory and figure out how the pieces fit together. I know that as a sophomore, an interesting interview question I got that I wasn't expecting was like, okay, so you've done all of these different valuations and you're putting them on a football field, which is a graphic that shows kind of like the range of valuations when you sensitize them. Which one are you generally going to expect to have the widest range? And I was like, what? That wasn't in the guides. And the answer to that was like DCF, because there are a lot more assumptions that you can flex and sensitize for. And so, generally you'll see like a wider value on your football field. But I give that as an example because there are a lot of questions in the guides that will pop up as interviews, but all the interviewers know that. And so they want to see if you understand how multiples are used and applied every day, and how the valuation methods compare to each other. So the final note that we would say is that you'll get questions around industry trends and overview. So you want to make sure that you're digging in and reading, Deal Book and all of these other publications and identifying which articles are more interesting to you than others, what you find yourself reading, and share that with your interviewer. It's also very likely that you will be asked about, a recent deal that intrigued you, likely in, whatever focus it is you've said that you're focused in. So whether that's IPO, M&A, etc. So be prepared with the background on that in terms of numbers, but also your own thoughts on the rationale and whether it makes sense, or like how you digested that deal happening. And then you also want to be aware of macro trends, so low oil prices, or like today, COVID and these crazy low interest rates, and how that might affect what you're seeing in the news. How companies all went out for financing in March and April and have all this cash now, and now have to think about how to use it. So just generally, you'll get questions around the industry, and you want to make sure that you're well versed in your interests and your view of the market. Okay, so a question for our panelists before we open up for questions. How does valuation get applied day to day?
Yes, I mean, when we're meeting with our clients, we think about valuation all the time, just in terms of how they evaluate their strategic decisions. So I work with a lot of private companies, and private family-owned companies tend to think about succession planning, and they tend to think about it every couple of years as their family reaches a point where they might change over control. And so we have a lot of kind of discussions with our clients surrounding that. Like, is it, is now the right time for you to sell, or should you wait? How many more generations of your family are you gonna see be active in the business? Questions like that. And we help, provide perspectives for them in the context of the timing in which they're evaluating those decisions to help them, make an informed decision.
I would add, in my world, natural resources, where you deal a lot of commodities, and special in times of such severe market dislocations, valuation plays a big role in any M&A process, right? So what you've seen in these last couple of months with COVID, Brent prices collapsing and all the commodities taking a downturn, is the bid-ask spread in any M&A transaction gets very wide, right? Because the seller will use its own assumptions, the buyer will use their own set of assumptions, and then the valuations of the same company gets really, really different. And that's when you have, when you feel a lot of difficulties in moving a transaction forward. So nowadays, for example, everyone is having a lot of debate about the cost of capital, right? Should we use the 0.2% discount rate, or will the markets normalize, and what is the new normal level? So you can do a lot of internal valuation on small projects. How does this affect the value of this company? Different capital allocation strategies. How does this affect my future share price? But usually the debate there, it's much smaller versus when you come to value big companies on either an IPO or in a sell side process. Is always difficult, especially in times where they're on such severe market dislocations. The debate is huge. And for example, since the COVID started, I was working on 4 live transactions, and all of them were put on hold just because we couldn't navigate the bid-ask spread due to these differences.
Yeah, I would. Oh, sorry, go ahead.
Go ahead.
I'll just note quickly that we work with our clients every day to help them think about downside risk and how to assess various different types of value drivers and potential sort of negative impact to those, and kind of help them think about where could there be what is a black swan event, how does their return kind of get impacted under that black swan event, and are they comfortable with that risk, and kind of help tell that story and the evaluation in an IC paper or something like that. So yeah, just a quick comment to add.
One quick thing I'd add is you don't just see valuation in M&A work or in a coverage model where you're talking to a company about how they're positioned versus their peers or intrinsically, right? Like, you see it even when you're helping a company do a financing. So for example, if a company is going to have an IPO and the company and its bankers are trying to figure out at what market cap and valuation the company should come out at, right? You're going to look at the comps, you're going to look at what the future cash flow is of the company, so that you can bring a financing to the market and bring a successful one, right? Because when you want to do a financing for a company, you don't want to have an IPO and then have the IPO sell off 20, 30% the first day, which we've seen in the past couple of weeks. So it's really a thing about, how do you position the company and its story versus its peers, versus its aspirational peers, and really kind of piece that all together to come up with a number, because a number is really a number, but the story is what matters to investors and to the company.
Thanks all. And I know that we've eaten into a lot of your question time, so students, again, want to encourage you to please reach out to us one-off. We'll go ahead and move into questions now and take what we can. So I think Terry maybe can share some of the questions we've seen over Pathable.
Yeah, absolutely. So this question is mostly, this question is from Chloe, and it's mostly for Madalena, Ferris, and Chris. How has this sustainable infrastructure / renewable infrastructure industry market evolved in recent years from a private investment perspective?
Yeah, so we've seen a huge surge in private investment in in renewable infrastructure specifically. I'll give an example. I'm currently working on 3 renewable energy deals and about to close or to announce one deal that I was working on next week. All of that is really fueled by renewable portfolio standard policies, decarbonization policies, retirement of heavy carbon generation plants like coal specifically, and in the long term we probably expect natural gas to kind of start to get phased out as well. So there's a huge push for demand for renewable energy assets, and there's a lot of capital that was raised over the last few years that is looking for opportunities to deploy. A lot of funds that raise a lot of capital looking for opportunities to deploy that capital in projects that they think can yield a pretty good return. And generally development projects, if you're willing to take on that kind of development risk premium, you're able to generate returns that are superior to an asset that is heavily contracted. So we've seen huge demand for such projects.
The only small thing I would add, though, is that there's actually so much interest for capital chasing renewables. It has dislocated as its own asset class with a completely different and much lower return threshold. Given the amount of ESG-focused funds, the return attach points for renewables are materially lower than kind of anything else in energy or traditional infrastructure.
I would agree, nothing to add.
Great, thank you all. And then there are 2 questions that I'm going to combine into one, which is, and this is more targeted at Chandra, where would you suggest looking for guides and tutorials to prep for the interview? And also, are there specific things that you would recommend to non-business majors to prep for the technical questions?
Yeah, so there are a couple of guides, and I may be forgetting the names now, so Terry or others, I'm sure you can help, but there's a steps on Wall Street or steps to Wall Street. What's the other? It's like valuation fundamental.
There's like Wall Street Oasis or something like that. I actually have a whole bunch of them in my inbox, so if anybody wants, like, feel free to ping me on Slack. I'm happy to send them all to you. They're all old, but I'm pretty sure they all are still the same.
Likewise, I've got a Google Drive folder of like 4, so just let me know and I'm happy to share. And then in terms of preparing as a non-business major, so I did interview as a sophomore, which was before we started our business classes at Ross. I was like halfway through an accounting class and really knew nothing. So those guides are very informative. Reading through, they do a good job of walking you through the basic fundamentals of accounting. Lots of YouTube videos. So I did a lot of the download myself, and then I went to peers who'd worked in banking and said, okay, like, ask me the questions that are not in this guide. Like, help me figure out how the pieces of the puzzle fit together. Test me on what I don't know so I can go find those answers, because the guides are a great starting point, but they're not prescriptive to what the interview will be like. So really try to talk to people who have done it. Probably first people in your network who are at your school. And then as you're feeling confident, then I would reach out to folks you've met at firms who you've had strong networking experiences with, maybe like 1 or 2 who feel like sponsors to practice interview you if you have a super day coming up.
The one small thing I would add, what I recommend is also sign up for Matt Levin's Money Stuff blog on Bloomberg. It's hilarious, but it's also really thoughtful on deconstructing what's happening in the capital markets and how that relates to the M&A market and kind of politics and a lot of other things in the world. So I recommend that just as a kind of daily piece of reading that can be helpful in preparing you for the thought process that will be successful in talking about the markets in interviews.
Awesome. So I think we are coming up on time, but I just want to share our contact. There we go. So please take a screenshot, whatever you need, take a picture. Feel free to reach out at any time and let us know of any questions. Happy to take more.
Yeah, and also if you want to access the slides and also this contact information, you can go to the Files tab, and this deck will also be there. With that said, I want to thank all of you, our session lead and session panelists, for participating in this, and also students, feel free to reach out to them anytime. We will end the session here today.